Mickey Dickey here, and I was going to do a video on this today, and I just happened to pull this up with Dave Ramsey, and I wanted to comment on a couple of things that he's now talking about because why not? Everybody seems to be wanting to talk about what's going on with the SVB. Now, again, I'm going to go through this video with Dave a little bit, and I know this isn't his area of expertise, and I know he's trying to be funny about it and go on, but at the beginning of this video, they talk about the fact that they want to quelch some fears, which I wish he would explain things a little bit better. So I want you take a listen to what he's talking about here, because he has some good points, and then he has some really bad points. And I'll make some comments as we're going along here.
Out there that have been sparked due to the SVB fallout. So for those that don't know, Dave, can you do like an explain like I'm five as to what happened with the Silicon Valley Bank collapse?
Yes. Okay. The Silicon Valley Bank was collapsed on last Thursday, I guess it was. And the reason was pretty simple. Number one, you need to understand this about their bank. That the vast majority of the customers in that bank were hedge funds, venture capitalists, and tech startups. They were not mom and pop. Granny's CD was not over at this bank. It's not who they catered to. Okay? So to put that in perspective, FDIC insurance of $250,000 covers up to $250,000. The government covers your deposits in the event of a bank failure. Right? The typical bank, it covers 75 to 80% of the deposits. In other words, some people have, rich people have $500,000 or $800,000 or $1 million or something in your local bank, but most people are $250,000 and under. This bank was the inverse of that. North of 90% of the deposits are not covered. That means these were all multi-million-dollar customers sitting in that bank. So these were players.
Okay. Now, I'm not going to debate whether the people that are in this bank are players or not. And yes, we know that a significant portion of the money in this bank was not under the $250,000 FDIC insured issue. But what I wish he would talk about more is that this is not the reason the bank failed. The bank failed isn't because it had players and it had money that was uncovered. The reason that the bank failed is because of a run on the bank. And we'll talk a little bit about it here in a minute as to what that really means. But I wanted to stop him here because he's making a big point about this, and it really shouldn't be. Because he's trying to say that this couldn't happen to another bank. The fact is it can happen to other banks. The reason it failed is not because they had players and the money was uncovered. What happened is you had people that were pulling money out of the bank, and the bank looked like it was upside down. Now, he's going to go on to talk about this in a minute, and I'm going to bring in again, as everybody knows, my Excel spreadsheets here. Now, I wish he would explain this a little bit better. He's going to try to a little bit here. What I want to explain here is that this is a bank that invested its money that was invested with him. And again, whether it was players' money or whose ever money, they invested in not just bonds, and that's all Dave talks about is bonds, but they also invested in treasury bills. Now, generally speaking, what most people consider the most non-volatile, the best, the least volatile investments out there, the least risky investments out there are T-bills, and government bonds or and just bonds in general, CDs, because they're guaranteed by the federal government. So the world would have to collapse for this to happen, and I'm not saying it can't happen, but that's what we're talking about here. But what I want to show you is that he does try to explain this, and I'm just trying to visualize what he's going to explain here in a minute. A year ago, you could get a bond or a T-bill for about 1%. So if you put $100,000 into it, and let's say it's a 10-year T-bill, like I've got on here. Now, today, you could get, or a week or so ago, you could almost get a 6%. I'm just using these as examples. Let's say today you could get $100,000 and you could get a 6% rate on a 10-year bond. Well, back in the day, and those of you remember this, they have the thing called mark-to-market. And the reason you see on a statement, if you have a CD or even a T-bill or a bond that you bought last year put $100,000 into, it's going to show you today a smaller number. Now, these aren't correlated in any way. All I'm trying to say is that in today's numbers, it could be worth $60,000. And all that's saying is that if you actually sold it today, try to get somebody to buy your 1% CD because they can get, or bond or T-bill or whatever, if they can get a 6% in the marketplace, they're not going to pay you full price for a 1% CD. or T-bill or whatever. But what they're not making this understood is that it's guaranteed to give you the money back in 10 years. So some of these CDs might be 2, 3, 4 years old, or T-bills or bonds. All they have to do is wait 7 years, and they get their $100,000 back. So even though it shows that it's $160,000 today, the CD comes due, or T-bill comes due, or the bond comes due, or whichever instrument you used, when it comes due, you get your $100,000 back. So even though today's value is down 40, 50, I mean, it could be 90%. It doesn't matter what the number is. You're going to get all your money back. So what the federal government did is they came in and they said, listen, we're going to take all this stuff because on books today, you're way down in value because you have 1% CDs. So if the government does this and they're going to get their $100,000 back, they're not going to have to lose $60,000. I mean, the same principle applies to a stock. If you buy a stock today and you paid $100 a share for it and it's now worth $60 a share, a week later or whatever, again, if you sell it today, you take a loss. If you wait for the stock to come back, you've lost nothing. The difference here is that you, again, barring whatever bond company or T-bill or CD that you have, unless it goes out of business completely, you're quote unquote guaranteed to get your money back. So that's what I want to focus on here. The biggest problem with this bank is that they took their clients' money and they invested it in very conservative investments, T-bills, bonds, CDs, things of that nature. And yes, they happened to have bought them in at a time when the market was, interest rates were low. So now today, with the interest rates being higher, it's going to mess. Your values are down. That doesn't mean it was a bad investment. Again, they're getting their money back. All they have to do is wait 7 years. So what hurt them is that they had people pulling their money out because of this gap, and they were trying to redo some of these. Now, I don't know whether that was a smart idea or bad idea or whatever, but they did have some of these rates that, from what I understand, they were trying to take them from a 1% and put them into a 4%, which in the long run would probably be a better thing for their clients, but in the short term, it messes things up, which is why my guess is why they were trying to pull some money and get some extra money so that they could actually make that adjustment. Because the inverse will happen to this too. So let's say, last week I could get a 5% CD rate. Well, because of what just happened, I can't get the 5% CD rate anymore because the market's down. But let's say a year from now, CD rates, rates are not at 6% anymore; they're at 4%. Well, that $100,000 CD or bond or T-bill we bought at 6% is now going to be worth more than what we paid for it. And this one that was at 1%, it was worth $60,000. Let's say at 6%. When interest rates go down to 4%, it's going to be worth, say, 80, and this one will be worth 120. So again, this is all getting muddied up here. What really happened to this bank is the run on the bank, which I would like to be more interested in how the run happened. Because if there hadn't been a run, we wouldn't be talking about the bank today. That's the biggest issue. It's not that they only had it covered. It's not that it's covered. It's not covered. I mean, if you're asking for the federal government to cover your losses, then, again, to me, that's not covered. It's just, it's covered by FDIC insurance. It doesn't mean they didn't have enough money in the bank to deal with it. But, most banks don't have all the money in the bank if everybody came and did a run on it. And that's what I'm trying to get at. When he says this can't happen, it can happen. Your local banks are doing the same thing. Now, again, the majority of the money in your banks are already covered by the FDIC. And all the government did here over the weekend was come out and say the same thing. We're going to cover this even though FDIC is not going to cover these guys. Now, again, they're not going to cover the bank, but the same thing would happen with your local bank. If you have stockholders, you have people that are, it might be a smaller bank and maybe it's not a public bank, maybe it's not on the stock market. It doesn't matter. If the bank falls, those guys aren't getting their money back. It's the same thing that's happening here. There's no difference in this scenario. So I want to go back to Dave because he's got a couple other things to issue. But I just wanted to explain this because it's not as dire as anybody makes it out to be.
And they done got caught. Okay, this is what happened. So this does not affect your local bank at all. It has almost nothing to do with your local bank. It's a bunch of Silicon Valley tech startups and venture capitalists from all over the place. I mean, I know I've got two friends in Nashville that are venture capitalists. They had money in that bank, lost money. Okay, but they're players. All right, they're not. This is not Granny's CD, for God's sakes. All right, so your bank is safe. Calm your butt down. This has nothing to do with that. And what happened?
Now, 100% agree with what he just said there. The banks are safe. They are in far better condition than they were in the '08 deal. And I know there's some people out there that are trying to make a correlation between what's going on today and what happened in '08. Please understand, there isn't a correlation. There isn't anything even remotely close to what happened in '08. The mark-to-market thing happened because the same thing occurred in '08. What you had is you had banks that were doing just fine. They had deposits, they had people making payments, everything was good. But they had somebody who bought a house for $1 million. And because the real estate market went down, the value of that home might not be $1 million anymore. Just like on the screen I had before, you put $100,000 into it, now it's only worth 60. Okay, mark to market. What they're doing is they're marking that asset to the value of today's market. So if you had somebody that bought a house for $1 million and now it's only worth $750, and maybe they borrowed $800,000 on it, whatever. Now you're underwater, so to speak, on your mortgage or what's owed to you on that deal. Well, in '08, what was happening is you had a bunch of those homes that were going underwater and they were not making the payments. If the people make the payment, it doesn't matter whether or not the value of the home is $1 million or whether it's $750. As they continue to make the payments, over time they'll pay it off. It's not an issue. Again, whether it's $1 million home or a $100,000 house, it's not relevant. The percentages are the same. As long as they're making their payments, it's all going to work out. So what happened when they did the mark-to-market thing, these banks can only lend so much money out of their bank. Well, if they were lending on a portfolio they thought was $1 billion and they could only lend, say, 10% out on it, and the market changes, and now the value of the portfolio is not $1 billion anymore, it's only $700 million, but they lent on $1 billion, they're going to be out of whack. Now, please understand that these percentages we're talking about here, and that's why I'm not using specifics, are all made up anyway. So the regulators have a script that they follow, and to have these banks in line with these numbers. It doesn't matter what the numbers are. The question is, how are people making payments? Well, again, in '08, you had a bunch of people that we were lending to people who couldn't qualify and shouldn't have qualified for these loans because they had horrible credit. So the assets, when they call them toxic or whatever, the simple fact is, what you have is not a toxic asset here. In the current scenario where people are buying T-bills and buying bonds and CDs and things of that nature, that all you have to do is wait for them to mature and you get your value back. Again, same scenario on the house. You're hoping the house comes back, but the house may not come back. Some people will tore them up. I mean, again, the house is a depreciating asset, which is one that Dave and I completely disagree on, but it is not an appreciating asset. Land is and can be, but even that's not necessarily true. But when you're looking at these assets, you have to look at these and go, is something in this bank, a T-bill, a bond, a CD, a toxic asset like what was potentially going on with the subprime mortgages? And the answer is absolutely no. So it is a completely different animal altogether. So yes, I agree with him for different reasons that your bank is safe, because again, it could have a run on any bank. Nothing can stop that. I mean, it's a wonderful life all over again. But let's continue.
What happened was, typically what banks do, this bank included, in order to have a balance sheet that is very safe to back up the deposits, is they will buy bonds. Now, if you didn't know, bond interest rates have an inverse relationship with bond prices. What that means is, as interest rates rise, bond values go down. So they had a whole bunch of bonds that they bought.
Okay, so this is the example I showed you on my Excel spreadsheet. Exactly what's happening. He's exactly right. They do have an inverse correlation. And so this is what he's talking about, is that the $100,000 bond's now worth, say, $60,000 or 10, or again, the number's not relevant to what it is, but it does go down.
Interest rates were 1.7, 1.8%. Interest rates are currently about 4% on the bond market, which means their bond portfolio had gone down in value dramatically, and they had billions in bonds.
So on paper, they had lost money.
So on paper, they lost a ton of money. Well, then they got scared, and a couple people got spooked, and they start unloading a bunch of those bonds, and then the rumor mill kicks in. The venture capitalist boys come flying in like they do and start scarfing the money, and they close the bank.
And that's what the bank...
Again, please understand, it wasn't the bonds, it wasn't the T-bills, it's when the people started panicking about it and started pulling money out of the bank. that screwed this whole thing up. It's not what these guys invested in, and it's not the fact that these guys that put the money in the bank were players. Okay?
Run is
close the
when
bank.
all the customers show
So
up at
your
once.
local bank, A, is going to cover the vast majority of depositors. You're fine. There's not a bunch of players in your local bank. That's not who's dealing in there. Even freaking Bank of America, which I hate, and I don't know why anybody would do business with them. They're horrible. But even they have almost, I mean, it's like 40% of their deposits are covered, right? And it's like these guys it was all rich people, super rich people in there. So it's just, number one, you wouldn't have money in a bank. Ugh. So bond interest rates have gone up, bond values have gone down. Consequently, though, to the bank crack and the closing of this bank, then they closed two others just like it because they were afraid they were going to. FDIC gets to pay for all this crap, and the FDIC starts shutting it down. When they smell anything looks just like this, they shut down two more, right? And took them over. They'll sell off the assets. They'll collect all the money to recoup the insurance. If there's any money left for the insurance, and there won't be, then they will distribute that to the people, the depositors. The stockholders will get zip, which is exactly what they deserve.
It was trading at $2.50 a share.
This is
now
called
it's zero.
Now, this is the part I wanted to explain. Yes, FDIC is going to come in and cover all the assets that are 250 and under and take care of it. The federal government over the weekend said that they're going to cover everybody else's as well. But again, how they're going to cover this is by taking over the actual assets of the bank. They're going to get the CDs, they're going to get the T-bills, they're going to get the bonds, which, yes, will take 5, 7, 10, whatever, how many years it takes to get the money back, but they'll get their money back plus some interest. So it's not a dire scenario. It's not something that's going to cripple anything.
Capitalism, when you screw stuff up, you lose your money. That's for those people that are in that bank. That's what happened. And they knew what they were in. Every one of them knew what they were in. Again, your grandmother's CD wasn't over there. You're okay. My local bank is fine. I've got deposits in excess of $250,000 in my local bank, in excess of all the limits in my local bank.
Here's the interesting part for me about this. And I know he's got his money and he's talking about this, and that's great. And he's saying that all these guys are multimillionaires and mega wealthy and yada, yada, yada. But no one's actually talking about the fact that it's not the owners of the bank, it's not the stockholders of the bank that caused this problem. And yes, they are going to lose their money because they invested in it. They bought stock, they bought bonds, they invest. That's it. My concern is on the people who put money in the bank. And I don't care whether they're a billionaire or whether they're the average guy on the street that has got $5,000 to put it in the bank. It doesn't matter to me one iota. Because in our current banking system, I don't understand why anybody should actually have to care. I mean, our banks should be fine. And he makes this sound like the people that put these billionaires that put their money into these banks, or this particular bank, that they knew what they were getting into. No, they thought they were putting their money into a bank, which is supposed to be regulated, which is supposed to be okay. Now, they might have understood that they would have more than the $250,000 in there, don't get me wrong, and that wouldn't be covered by FDIC, but I don't think any of them really looked at this bank as being in trouble. And none of the regulators did. No one came up and said anything about this. So I don't blame them on that part of it, but what I do blame them for is someone had to do the run on the bank. That has to be the billionaires. So if they're the people that have the money in it, they're the ones that were pulling it out. Why would we not stop this? Or, which again, we're in a day. I mean, this isn't a situation where where you have to go down to the bank and do a run on a bank by actually physically going down there and pulling your money out like It's a Wonderful Life. People could pull their money out in their skivvies at 1 o'clock in the morning, but they did this to themselves. So I do understand that, but on the other side of it, I don't see this as being a billionaire problem or anybody else's problem, because again, this could happen all the way around. But let's finish this up here.
Not worried about it one iota, not a penny. Okay, but the great news is the bond market freaked out because they kind of caused this with the interest rates going up, and bond interest rates dropped. Bond prices went up. Translation.
Now, he's saying here that the bond market caused this by interest rates going up. Okay, now there's a long story to get to that, but it's not the bond market did this. In fact, the bond market was trying not to do this. In fact, the bond market was getting all sorts of heat last November and December because they weren't following what Powell at the Fed was doing. This is done by Powell, and make no question about this. Most of us have been screaming at Powell since at least October or November to stop raising rates because we haven't allowed the time to see what destruction raising rates has done. He has raised rates so quickly and to such a, and again, I know it's not 18, 19, 20% like it was in the Volcker era in the 80s, and I don't want to go back to that. But the percentage increase going from 1% or zero, to 4.5, or whatever number we're at now, I don't even care. It doesn't matter because the question is, where are we going to stop? They've been telling him to stop for some time, that something's going to break. Well, we broke something, and it's here, so keep that in mind. But the problem here is that this isn't the bond market doing this. If most of you, if you probably don't remember this, but back in the late part of November to early December, there was a huge disconnect between where interest rates were and what the Fed Powell was doing, what the bond market was doing, and they were taking into consideration, they thought there would be a cut in interest rates a year or whatever. But the mortgage rates, if you remember, had gone down during that time frame, even though interest rates were continuing to go up, and they were anticipating different. So the market was completely different than what the Fed was doing, which you've heard me say this before, and I'm going to continue to say this. Don't fight the bond market. People say don't fight the Fed. I'm sorry, don't fight the bond market, in my opinion, but regardless. So what's happened here in January was the same thing, and then February the thing turned. All the bonds started going up. Everybody was freaking out because we had inflation went down, but not as much as we thought. Okay, but it's still going down. And again, all we have to do is look at the numbers year over year and realize that oil was up in January from last year to this year. And now February just came out today at 6%, and gee, it was a little bit lower than last year. Well, wait till next month. Next month gas prices in last year were at $4.30 a gallon. They're still at like $3.40, $3.30. You're going to be down 20, 30% year over year. Guess what that's going to do to CPI next month? Again, focusing back here on the SVP, because again, this is not a bond market problem. This is what the Fed's doing problem, and they need to stop.
Your mortgage rates are cheaper today than they were this time last week. If you were going to get a mortgage in the next month or so and get a house, run to your mortgage company before all the dust settles on this. This is a great time to get a mortgage. Go to Churchill Mortgage today and lock in your mortgage.
Thanks, Dave. Really needed to hear about Churchill Mortgage when we're talking about SVP. But again, I digress.
Because this is an anomaly. It may settle back up by 2 weeks from now. All right. But it dropped a quarter to a half, depending on what kind of mortgage you're looking at, because bond interest rates went down. Bond prices went up because these dubers were flooding the market with their bonds, and the bond people went, oh, look at us.
Okay. The bond market didn't do what he's saying is happening here. It wasn't a bunch of dubers dropping a bunch of bonds on the market that this ended up happening. Not at all. What happened here is the bond market, again, back in November, was planning on the Fed not raising rates to an extreme amount. Last week, they were expecting the terminal rate to continue to go up. They were expecting next week for Powell to actually raise rates by 0.5%. Here's what happened. Because of this scenario going down, everybody was talking about how strong the economy is and how that's a bad thing, which again, any of my other videos, you listen to me, they're morons. Strong economy, strong labor force, strong everything else is a good thing. I don't care what anybody says. It's always a good thing. But because everything was going up, the bonds were going up, and that's why you saw a huge increase in the bonds. What happened yesterday is this is now a big event. We have a very large bank that's going down. We have 3 of them now that are going down. This is a problem. What in that vein, Powell will not be able to continue to raise. If he raises next week, it's over, in my opinion. I don't think he can raise again, because we're going to get CPI, because they only come together every 6 weeks. So if he raises next week, it's going to be another 6 weeks after that. There will be 2 more CPI prints with oil at $4.30 a gallon and $4.60 a gallon, and we're still in the 3/4s. So the March, April, May, June, June was at $5 a gallon. Inflation's just going to drop off the planet after the next several months. So he's not going to have anything in his favor. Even if unemployment stays down and that goes, the numbers are not going to be in his favor. He's not going to need to raise it. So if he does next week, it doesn't really matter. What this really told the bond market is we're done. He's not going to go another 1% higher than it is, which is why you saw the increase prior to this. So what he's talking about here is exactly wrong. That's not what happened.
We support all the local banks because almost every local bank everywhere buys bonds to put on their balance sheet to, quote, stabilize their balance sheet. It only stabilizes their balance sheet, which is the great joke of the bond market, if the interest rates are stable. But when interest rates go up from 2 to 5, guess what? Your bond prices go down.
And then everyone shows up at the bank.
And that bond you bought that was so stable now is worth less because you were betting on an interest rate market to give you a stability, and that was a dumb move.
When you buy a bond, you're buying it because you know you're going to get a return or a T-bill or a CD for that time period. The fact that it goes down the next day because interest rates went up is not relevant. What you did is lock in a specific amount on a return. I don't care what you say, Dave, you're completely wrong here. Again, your value might go down. That's not relevant to the scenario. It's not a dumb move to put things in safe investments.
So here we go. All that to say, get your mortgage right now. Go to Churchill Mortgage today. And if you're thinking about buying a house and you're just kind of on the fence, this is going to be your month, baby. This is going to be the time to jump in. Jump online, get you an ELP with real estate, whatever it is you got to do here. This is the time, and people are going and buying gold, George.
Oh my goodness.
Banks are going to fail. It's like they live in the Wild Wild West or something. You don't know how the FDIC insurance works.
Okay. Now, again, the people that are going out and buying gold, again, I'm never going to beat anybody up for that. But we do have to understand, we're not on the gold standard. So yes, he's going to say this in a minute. He's exactly right on this part. The federal government would have to fail before this becomes an issue. But buying gold has nothing to do with the $250,000 FDIC insurance part. People are buying gold because they have investments that are continuing to go down and they're tired of them going down, which what they don't understand is that gold goes up and down, and right now gold's kind of at an all-time high, so not quite, but pretty close. So it may not be the right time to buy gold either, but we're not on a gold standard either. So there's not necessarily a reason to go out and buy gold. There's definitely not a reason to buy gold because you think the banks are going to possibly fail, because again, they're not going to fail. The federal government has made that very clear that they're not going to let that happen.
Our federal government would have to fail for you to not get your money out of your bank when you have less than $250,000 in your bank. Acting like you're...
Don't cash out your bank. Don't cash out your investments.
Everything on the internet's true. Abraham Lincoln said that. I mean, come on, guys. You believe every conspiracy theory out there. These banks are not on the wire. They're not about to collapse. It's going to be like 2008. 2008 was not a banking collapse. It wasn't what happened.
And again, he's right. We talked about this. What happened in 2008 is not what's going on here today. So the other part of this I want to make sure we understand is that there's a couple of issues with the banking going down that I want to make sure we focus on. And again, it is not an all-time record. It is not even though it is the third largest, it's nothing in comparison to what Lehman Brothers or the others back from 2008. But when we look at what's actually going to happen, I think this is actually going to be a positive thing, what's going on here. I think what's going to happen is Powell is not going to be able to continue to raise rates. The market has been way too concerned about what Powell is going to do on a short-term basis with the economy and beyond, to the point where we've seen daily moves of 1%, 2%, 3%, which again is not normal, and it's not productive, and it's not real. So when the Fed is talking about going up in rates next week, which the odds of him doing 0.25% have continued to go down, and whether he does or he doesn't do the quarter is not really relevant. The question is, going forward, is inflation really going to continue to go down? Now again, we all expect inflation to go down drastically over the next 4 months. Most of us think it's going to be in the 4%, maybe even under by the June print that comes out in July. The bigger question is, what does it happen to unemployment? But the market is going to look at this, and most probably Powell is going to, he's not going to say this, okay? He's not going to say that he's going to pivot. He's not going to say that he's going to stop. But what he is going to say is, we've got some other issues here we have to address. And this is, and again, I'm going to use the term Lehman moment. We've broken something here. And that's what a lot of people have been waiting for and expecting it to be something that he can at least point his hat on and go, hey, we've hit that point where we no longer have to push up. And, again, he may do the quarter, but after that, it shouldn't happen. The market should take this very positively in the stock market. The economy, I don't think we have a problem either way. but you're probably going to see the stock market have a little uptick here and go forward. The question is, how sustainable is it, and do we end up getting back to where we need to be? But this is not an event that's going to be cataclysmic to the rest of the banking system, or shouldn't be, unless everybody's pulling all their money out of every bank at the same time. Because again, that is what's happened here. It is not the fact that they had a bunch of billionaires with their money. Not at all. Because this could have happened to any one of the banks if there was a run on it. Why there was a run on it, in my opinion, needs to be questioned. Because there really shouldn't have been. And if there was a run on it and there was a concerted effort to it, then it's the same thing I've said before, just like the Reddit people that ran up the GameStop numbers and the AMC numbers, and they do it from time to time. If somebody's getting together on a web page or on a vlog or something, and they're all colluding together to either do a run or short a stock or do something like that, that's illegal. And I would really question whether that's actually happened here. Because again, if there really were that few people in this and really billionaires, who was pulling the money? It had to be this billionaire. So did they get together and do that? I mean, I don't really know, because there's no way to actually find out, and maybe at some point down the road we will. But to me, that's the bigger issue. It's the run on the bank. If we didn't have a run, we wouldn't be talking about this bank today, which means we probably wouldn't be talking about the other banks. But it is not the investments they're invested in. It is not the fact that they put their money in 10-year T-bills or 10-year CDs or 10-year bonds or whatever in the world they did. They didn't put stuff into risky stuff. They put things into investments that are solid. Dickie out.